It's just a hugely unfortunate event and a serious event. As you just said, as one of your colleagues just said, we've launched an immediate investigation into how this happened. It's going to be overseen by Baroness Sarah Hogg, and we are drawing on the expertise of Kieran Martin, who was formerly CEO of the National Cybersecurity Centre. So we'll get to the bottom of it. They'll produce a report. They'll do it very quickly, and we'll see what really happened yesterday.
I think it's quite telling. We've got three lines here from what the Chancellor is saying this morning and the wash up from the budget. And one of the other lines too is saying there's more action I will take to grow the economy. So tackling one of the biggest criticisms that the budget did not contain enough growth measures, despite lots of promises of trying to grow the economy from here. All in the context, we're looking at slower forecasts in coming years for the UK economy. What do you make of the lack of growth drivers?
One of the main reasons why the projections we've made for growth are a bit weaker than in March is that we've taken the view that the underlying rate of growth of productivity in the UK is a bit weaker than we'd thought. We haven't really seen a bounce back in productivity growth after the big shocks of COVID and the energy price rises in 2022. And now enough time has passed for us to think that probably productivity growth will be a little bit weaker than we thought. So that's one of the main factors behind relatively slight downgrade in the growth projections. Of course, it's very difficult when a government raises taxes on a large scale, and this was a big tax raising budget, to simultaneously boost growth, because it's very difficult to increase taxes without that having some side effects. They were offset by some other things in the budget, but the net effect is that the budget as a whole hasn't, at least over the next few years, boosted growth because there's offsetting pluses and minuses.
Sir, it seems as though the bond vigilantes, of course, they have been watching, and they were arguably soothed by what they were hearing from the Chancellor yesterday that said there's some uncertainty when it comes to the backloaded nature of some of these fiscal measures. How questionable do you think the path is when it comes to that?
You're right, and those people looking at the budget are right to draw the conclusion that the consolidation in the tax position is backloaded. In the near term, borrowing is higher. It gets lower toward the end of the forecast horizon, and that's really when the tax rises kick in, and they're large. Tax measures raise another 26 billion or so of tax revenue. That's largely in 2028 and 2029. And of course, the further ahead plans are, the more there'll be questions about will things actually play out that way. But the strategy is to increase the margin against the government's targets. And on these plans, that does happen. It was £10 billion on our central forecast of the government margin against meeting its fiscal targets 4 years down the road. That's now on the current trajectory. We assess something in excess of £20 billion.
But of course, if economic growth falls further, and again, down the track, that is certainly possible, given that trend growth is so weak, that means tax receipts, tax income will be falling as well, giving the UK even less headroom. So how precarious is that situation, even if right now that 20 billion figure looks quite comfortable?
Yes, of course, there are risks on the downside. I think there are risks on the other side, the positive, optimistic side. I think our assessment at the OBR is that we've produced a sort of central projection, central forecast, where the risks are symmetric. There's as much chance that we get some good news in the economy in the UK, and we've been short of good news for many years now, going back really to before the financial crisis. So I think there's as much chance that actually things turn out better than our forecast fiscally, which would, allow adjustments in a more favourable direction, some reductions in tax perhaps, or increases in spending, and still hit the target. So I think we've got symmetric risks, some on the good side, some on the bad side, and let's hope that we get more of the good ones rather than the bad ones, which predominated really for a long time now in the UK.
David, let me tackle spending with you. The Chancellor this morning saying, I do not accept that we are raising taxes to fund welfare. But the reality is public spending is going up to fund some of the welfare. And yesterday, scrapping the two-child benefit just seemed tone deaf when the Chancellor was passing the cap around, asking everyone to contribute more. As we think about welfare into the future, an ageing population, growing demands on the state, is it only a matter of time before harder choices around welfare spending need to be made?
You're right that increases in welfare spending were a significant part of the increase in government spending. They weren't the only part of it. I mean, there were some increases in debt interest because interest rates are a bit higher now than they were back in March. And there were some pressures on local authorities, which has caused local authority spending to be higher, and that flows through to the government accounts as well. So it wasn't just welfare, but it certainly was, a significant part of the increases in government spending were welfare related.
The difficulty around this budget was tackling some of those short-term fiscal challenges, but not steering the country off course for the long term. And to me, what was incredible was to see this removal of the salary sacrifice benefits and just taking the level down to 2,000, which to me just disincentivizes a whole big tranche of the UK to put more money away for pensions that ultimately take the burden off the state later on, but also short-term puts more pressure on employers that have been contributing even more to national insurance contributions. How are you thinking about how pensions in this country should be managed for the long term so that the state is not paying more with the ageing population?
It's a huge challenge. It's a huge challenge in the UK. It's a huge challenge right across Europe and for many countries outside of Europe as well, the ageing of the population. And one of the reasons why in our projections, the OBR projections for the very long term, not just the next 4 or 5 years, but beyond that, looking ahead as much as 50 years into the future, it is more than anything else the demographic change, the aging of the population, which generates a profile for spending and tax revenues that ultimately is unsustainable without some kind of fundamental changes in the tax and benefit system and the whole system of savings for retirement. There's some good news on the demographics, which is that alongside an aging of the population, we've had over many years now, decades in fact, an increase in life expectancy. And much of the increase in life expectancy is years in which people are relatively healthy. There's nothing magical about the idea that people work until they're 64, 65 and then just stop. So there is scope, certainly over the longer term, for sort of adjustments in the labour market and for people to find in their own interest that they want to work longer. And that's one of the offsets to an ageing population. It's almost like having to redefine what old age means.